This is MacroVoices with hedge fund manager Eric Townsend, the free weekly financial podcast targeting professional finance, high net worth individuals, family offices, and other sophisticated investors. MacroVoices is all about the brightest minds in the world of finance and macroeconomics telling it like it is, bullish or bearish, no holds barred. Now, here are your hosts, Eric Townsend and Patrick Ceresna.
Let's get to this week's Postgame chart deck. Listeners, you'll find the download link in your Research Roundup email. If you don't have a Research Roundup email, just go to our homepage, macrovoices.com, click the red button that says Looking for the Downloads. Patrick, the chart deck is titled Summer Grind. We've only got 2 weeks left till the beginning of summer, so I guess we're jumping the gun a little bit. What's going on?
Well, obviously official summer starts a few weeks from now, but here we are in the month of June, and the market has already started to trade sideways. So on page 2, we have the S&P 500, and listen, we've been in a pretty clear bear market style price action since the start of the year, and we were quite oversold in the month of May, and we got a bounce. And one of the things that I'm speculating is likely to have at least above average probability of occurring is that the stock market has numerous fake outs to the upside and downside in the coming weeks. And the bigger question, was it a meaningful market low? And could there just be a new bull trend that begins from it? Or is this just a typical kind of bear market rally, typical bounces that come from an oversold condition that ultimately will be faded? And what I sort of mean by the summer grind is, while I do suspect that this is likely to be a bear market rally and fade, it's also quite possible that we're going to go right into July just chopping around with substantial overhead resistance. I marked off in the green zone some of the fib zones and previous lows where the market should start to meet some distribution and find it difficult to beat those upper levels. And if we see, let's say, over the coming 3-4 weeks into the summer, the market can't seem to beat these levels, I would become highly suspect that another breakdown move may be coming in the latter part of summer. But for now, I think it's very possible that we're just going to grind here going into July. What do you think of that thesis?
Well, Patrick, it's very consistent with my outlook. And when you said if the market can get above those key levels, I think what that really means is if there is, in fact, evidence, as a lot of people are assuming is coming, to say inflation really was transitory, it's all behind us, we're headed back down to 2%. If that all starts to play out and the Fed put is alive and well, then I think you probably get back to new all-time highs. I don't think it's going to go that way. I think we're much more likely to see a situation where we realize that inflation was not entirely transitory. There really is a secular trend underlying that temporary pulse of transitory effects, and we're probably going to see this bear market rally continue until it stops. I don't know if that's where it is now or up to the top of your shaded area there. It could be in there anywhere. And I think eventually we maybe get a setup to realize between food crisis and increasing inflation, increasing yields, that a perfect storm comes together and it really sets up a potential crash. Darius Dale told us that a crash could be coming this year. We want to try to get him scheduled on the show and get an update on that outlook as well. Let's move on to the dollar-euro cross on page 3. We've been watching that one closely for the last couple of weeks. What's your take?
Well, it's similar to the overall theme is that we're in a very oversold condition. We got a bounce, but one has to really reflect on the magnitude of the bounce so far, and it's been pretty pathetic. At this stage, you would have thought that if it was truly a meaningful turn point and a short-term low, that the velocity of the rise could have had a little more gusto behind it. We should have been able to achieve 109, 110 on the upside of a reversal. Instead, just a quick, 200-300 pip reaction off the low, and it's already struggling. This doesn't bode well for the euro, and really does, in my mind, leave the U.S. dollar rally in play. And when we go to page 4, when we really see what's moving, it's that U.S. dollar against that Japanese yen, and that took absolutely no time to clear that May high, and more importantly, even the velocity of the rise seems to have have accelerated from its previous ones. And you would think after a 2,000 pip advance like this that there would have been a period where it's been priced in and would be a slowing momentum, but it doesn't seem to be slowing at all. And this to me really does put a short-term bull trend in the dollar as still the primary trend and one that has to continue to be respected.
Patrick, do you have any insight on why the strength is all in the yen and not in the euro?
Well, I think that it continues to be the yen story anyway continues to be all about the Bank of Japan's willingness to keep defending the yield curve control, and I think maybe the market may be testing Japan's willingness and resolve to stay to their YYC policy, or whether or not their market can make them blink. And that's pure speculation, but clearly that has been the short-term driver as they continue to leave their rates pinned. Making money flow completely moving only one direction there. With that said, Eric, let's move on to page 5 where we have the crude oil chart. And really, I don't know what to say beyond last week other than that the trend remains quite bullish, quite intact. And while we have not cleared on the continuous contract, the March high, we certainly have done it on the trading contract of the July, which is the one that traders are trading right now, as well. Things like the ETF of the USO, which is what most retail traders get exposure to crude oil, has already broken to higher highs, and we continue to see oil trending so strong. The only thing that it kind of I ask in the back of my mind, the question I think about is this idea that it's becoming very consensus that oil is going higher, and it seems that almost anyone and everyone at this point has jumped onto this bandwagon. Do you think that sentiment will play a role in increasing the volatility, or do you think that's just now going to only accelerate this trend?
Well, I think it's a question of the timing of unforeseeable events, and you're absolutely right. We've come so far so fast. There's lots of room here for a $10 correction just to shake out the weak hands, for no other reason than that. If we saw the data soften and we took a little break from all of these fundamental news factors that keep popping up to push hot prices higher, then that could easily happen. The thing is, we've got so many bullish factors, and I think more still to come. We haven't really seen the mainstream come to terms with the fact that the world is out of spare capacity. And, you get a lot of excitement and attention being paid to what's going to happen at the next OPEC Plus meeting, and Biden's going to go to Saudi Arabia and meet with MBS, and, what if they reach some kind of deal in order to increase capacity, blah, 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 blah. I don't think that they can increase capacity. They've actually been pretty clear about saying that. So unless they're completely bluffing, which doesn't make sense to me, because to bluff about that would undermine their own negotiating position, I think that we're in a situation where there's a lot of very bullish factors that will take us much higher. And potentially then what you get to is in August, you get to, okay, surely this has got to be the blow-off top because oil prices are so high, nobody can believe it. And then what you realize is, wait a minute, Europe's whole energy problem doesn't really start until the fall. That's what exacerbates the geopolitical tension. And maybe instead of coming off of an August high, there's actually just a little reprieve into September. And by October and November, the season when Europe urgently needs Russian gas in order to heat homes in Europe, all of a sudden there's a escalation of geopolitical tension and another big move up in oil prices. That's lining up a lot of dominoes, Patrick, and we could see all kinds of things happen, including some great big grand peace treaty between now and then. But frankly, we're at a point where we're out of spare capacity, and I don't see demand coming off. If anything, Chinese demand is going to come back in to the equation, and that's going to push prices higher, just as the UAE's energy minister said this week. Let's move on to gold futures, though. Now, there's a boring market that really is boring, and you can't go to the Japanese gold in order to make the U.S. and Euro gold look any less boring. What's going on here?
Well, listen, I remain bigger picture bullish gold, but there's no denying that the price action has just been very disappointing. And what I wanted to just move and look at the chart going back at the start of the chart when June and July of 2021, you can see that the price action looks very similar. It was just starting to bounce off of a little oversold condition, and then it rolled right over for one more dip. And while it did break to lower lows back then, it didn't really last. It just kind of dipped down there and recovered. And then if you look in the January of 2022, just at the start of the year, similarly, you can see through December and January, the market just kind of grinded higher and then went to retest the lows. I kind of suspect that the summer will look a lot like this for gold, which is in the bigger picture probably does have upside, but for the short term, there's a high risk that this is just going to grind, and we may have a couple trips right back to the bottom end of these ranges, and then quick recoveries that keep it in a very tight trade range and keep it quite inactive. And I think that there's an increasing chance that that's going to be the story for the summer.
Patrick, let's move on to lumber futures. They went absolutely to the moon as we saw a relocation trend from the COVID pandemic. A lot of people getting out of cities, building homes in the countryside. Boy, it looks like the price action from the pandemic is totally out of the system now. What's going on?
Right. Like it's just worth observing that, I've had a number of people that have tried to pitch me on the idea that home builders are imminently going to be a great opportunity. And while I do understand the principle behind that thesis, and in fact, it's not wrong, it's just about whether or not the timing is right. When I look at this chart and see how lumber prices have been hammered, it's very much an indication that there is an economic slowdown underway, and higher rates and investor home buying confidence is being hurt right now, and that is being reflected on the demand for lumber. And we're now approaching levels that we've seen both in 2020 and 2021 at the bottom end of the range. Will be really interesting to see whether this is now going to be where at least some short-term support starts to be established. I think it's very premature to speculate on the upside of lumber yet, but we're now approaching some key supports. So it'll be interesting to see whether this is where the bottom end range of the lumber will end up being. But Eric, what I wanted to do is talk about nat gas on page 8. And nat gas has been very strong. Gasoline futures have been very strong. Oil's been very strong. A little bit of noise here on nat gas as there was fire that occurred on an LNG distribution point. Was a headline the other day. But the one thing I want is really kind of reflecting on is that the story that is that Biden is talking about the fact that they will supply natural gas to Europe, and that this is the way that the world is moving forward. But when I look at this move on nat gas, and then go to page 9 where I have the natural gas term structure, what's amazing is that these higher natural gas prices are only being reflected in the 2022 contracts at the December. Once you go beyond the remainder of this year, the prices of nat gas literally fall off a cliff. And, a decade out on the term structure, we're back down to the levels where we have typically seen nat gas trade over the last, it actually really hasn't even moved over the last a year or two. And the question I sort of have in the back of my mind here, Eric, is that, well, if really the world is moving toward this idea of LNG and this movement of the North American gas over to Europe and other things like that, why has it not started to be reflected farther out on the term structure versus simply just reflecting here in the next, half a year of contracts? Do you have any ideas as to why this is playing out this way?
Well, Patrick, I think you're really onto something here, because as we have discussed on MacroVoices in the past, this move up in natural gas is not just a short-term interim spike. Now, I think that to answer your direct question, why is this not being transmitted further out on the futures curve? I think the answer is most people are assuming that President Biden's promises to supply gas to Europe are a short-term thing, and maybe they're expecting that this whole situation between Russia and Ukraine is going to be resolved by next year, and therefore the demand for U.S. natural gas to be exported to Europe is going to go away. I don't think that we're headed there at all. I think we're actually headed towards a balancing eventually where U.S. natural gas prices and European natural gas prices converge, which would be at a much higher level. Now, if that's right, as you say, it would be those longer dated futures contracts further out on the curve that would provide the most speculative opportunity to the upside. Remember, they call this contract the Widowmaker for a reason, and if you saw a U.S. recession occur and at the same time you did not see an escalation of the geopolitical tensions that are driving the demand for U.S. gas to be exported to Europe, that could cause things to really crash quickly. And I think also that in this market, in the nat gas market, because it's so volatile, not that many traders are willing to take long-term speculative views. Like what you're talking about is, boy, look at 2 years out. I could buy that contract 2 years out, and if the situation goes the way we expect it to, which is to say that over time the U.S. will continue to export more and more of its natural gas to Europe, build more natural gas export terminals in the United States, build more ships to carry the liquefied natural gas over to Europe, and so forth. If that whole trend continues, there's a great speculative play to be made on those longer dated contracts, but not a whole lot of institutional players are willing to make a nat gas bet that far out on the curve, and I think that's the reason nobody's speculating in it.
All right, well, I want to wrap up the chart deck by just touching on yields, but rather than looking at the 10-year yield, I wanted to look at the yield curve. Particularly, I cherry-picked the 5s, 30s here. The 2 10s don't look that different. But what we saw back at the start of the second quarter was a yield curve inversion, as we basically saw this go negative. And we got a bounce since then. But so far, this has been an incredibly weak bounce. And in fact, it almost feels like it's rolling over again, like if we're heading right back down. It's really interesting that when you go out into the 2 and 5 year yields, that they continue to trade very close to the levels right out to the 10 and 30 year. Like we have a very flat yield curve going out this way. And it doesn't seem like inflation, obviously inflation's being priced in to the shorter contracts in the middle of the curve, but it doesn't seem like those long-dated contracts have really exploded yet. It'll be really interesting to see whether or not this stays very close to the zero line here in the coming weeks, or whether we finally see a steepener starting to kick in.
Folks, if you enjoy Patrick's chart decks, you can get them every single day of the week with a free trial of Big Picture Trading. You can get the information on page 11 and 12 of the chart deck, or just go to bigpicturetrading.com.
That concludes this edition of MacroVoices. Be sure to tune in each week to hear feature interviews with the brightest minds in finance and macroeconomics. MacroVoices is made possible by sponsorship from BigPictureTrading.com, the Internet's premier source of online education for traders. Please visit BigPictureTrading.com for more information. Please register your free account at MacroVoices.com. Once registered, you'll receive our free weekly Research Roundup email containing links to supporting documents from our featured guests and the very best free financial content our volunteer research team could find on the internet each week. You'll also gain access to our free listener discussion forums and research library. And the more registered users we have, the more we'll be able to recruit high-profile feature interview guests for future programs. So please register your free account today at MacroVoices.com if you haven't already. You can subscribe to MacroVoices on iTunes to have MacroVoices automatically delivered to your mobile device each week free of charge. You can email questions for the program to mailbag@macrovoices.com, and we'll answer your questions on the air from time to time in our mailbag segment. MacroVoices is presented for informational and entertainment purposes only. The information presented on MacroVoices should not be construed as investment advice. Always consult a licensed investment professional before making investment decisions. The views and opinions expressed on MacroVoices are those of the participants and do not necessarily reflect those of the show's hosts or sponsors. MacroVoices, its producers, sponsors, and hosts Eric Townsend and Patrick Ceresna shall not be liable for losses resulting from investment decisions based on information or viewpoints presented on MacroVoices. MacroVoices is made possible by sponsorship from BigPictureTrading.com and by funding from Fourth Turning Capital Management, LLC. For more information, visit MacroVoices.com.